What are commodities? Commodities are basic goods that are interchangeable or tradable. I say they're basic because most commodities are harvested or extracted from nature. Examples are metals, gold, coal, oil, natural gases, timber, but also potatoes, rice, tea, coffee beans. There are two big groups of commodities. Soft commodities are typically harvested, such as grains, rice, tea. Hard commodities are typically mined, such as gold, silver, oil, natural gases. Commodities are different from products because they describe a class of good. For example, coffee beans. A product is an instance of a commodity, and it usually comes out of a particular way of processing a certain amount of that commodity. For example, George Clooney's favorite cup of coffee is an espresso. An espresso coffee pod is a product derived from the commodity, which is coffee beans. When determining the price of a commodity, we have to look at the whole market. Although there can be slight differences in quality, commodities are considered equivalent within their class and grade. This is to say, coffee beans are coffee beans all over the world and cannot be mistaken by rice or gold. There are well-established markets for trading commodities, which are called commodity exchange markets. Some examples are Euronext, a European exchange, Multi-Commodity Exchange of India, the New York Mercantile Exchange, and so many others. Each stock market has a code. For example, the New York Mercantile Exchange is coded with NYMEX. The role of the exchange market is to standardize the quality and tradable quantity of a given commodity. Oftentimes, the price of a commodity in a given market is affected by the laws of the country in which the market operates. You may find that the price of grains in the New York Mercantile Exchange is different from the price of grains in the Multi-Commodity Exchange of India. Therefore, a commodity is described by the market code, class code, and subclass code. The people operating the trades are called commodity traders. They buy and sell commodities or futures contracts. A futures contract is a legal agreement to buy or sell a commodity at a predicted price at a specified time in the future. Traders usually use other people's money to sell or buy commodities. These people are called investors. You are an investor when you buy a certain amount of commodities with the intention of selling it later. Since the futures contract is standardized, ensuring the quality and quantity of the traded commodity, the only variable aspect of it is price. Price is determined through offering and bidding. Determining a price of a commodity is called quoting. The exchange guaranteed that the futures contract is honored by setting itself between the buyer and the seller. So, if Mark wants to sell coffee beans to Karen at $2 in the month May, through the New York Mercantile Exchange, Mark and Karen will sign a futures contract. After this, the exchange will buy Mark's coffee beans with $2 and sell the same coffee beans to Karen with $2. In a way, the exchange market becomes a buyer for every seller and a seller for every buyer, so it reduces the risk of Mark not getting his money on time and Karen not getting her coffee beans on time and at the specified price. Time for a joke. Question: is a Halloween monster good at math? Answer: no. Unless you count Dracula. Thanks for watching. Please like, share and subscribe.